Hi, everybody. Welcome to our DAT IQ Weekly Market Update. This is our update for October 28. It's the last week of October, the last full shipping week of the month. It's episode 360. I'm Dean Croak, market analyst here at DAT Freight. Special guest today. Been a long time since we've had Todd on from ATBS in Denver. Todd, good to have you back.
Hey, Dean. It's a joy to be with you. I always enjoy the show, and it's good to catch up, too.
Yeah, you've just had your quarterly or your half-yearly benchmarking webinar, which I watched a few weeks ago.
We did, and along with that means we go out and visit with a lot of people in the industry. So been on the road for 6 weeks, which is always fun because you kind of get to hear what's going on in the real world, and it's a changing market like always, right?
Yeah, we've had we've sounded a bit like a crack record for 3 years, haven't we? But I feel like something's changing finally. It really does.
We can only hope and pray.
Yeah, I've loved listening to your narrative on the market for the last 5 years because you've been really accurate because of your database, right? All of your owner operators have really been the pulse of the industry.
Yeah, we kind of live where the rubber hits the road with those, one truck drivers out there and hear how they're doing every day. And it's been a struggle, but surprisingly, a lot of them have hung on a lot longer than they have in the past, right? So it's, times change.
For those that don't know Todd and his operation, Todd, tell us a little bit about ATBS and what you guys do in Denver.
Sure, Dean. So we've been in business for 26 years. And the core of our business is we do accounting, tax, and business management for independent contractors. We've got about 20,000 clients, and they make up all segments of the industry. And really, a couple of things that are really fun about what we do is because we work with 20,000 drivers, we have great data and we can see how their business is doing every week, every month based on revenue and expenses and net income. And the best part of what we get to do every day is use that data to help our drivers understand how to survive in a market like this, how to make more money, decisions they got to make to be successful. And at the end of the day, we do tax returns for all those drivers. So, we see the real true numbers, and been doing it a long time. And when you watch data for 20 years, you definitely sense change when it's happening. And a lot of fun.
Kind of interesting. You're at one end of the spectrum. We're at the pointy end of the stick where all the rates start, right? So
it's true. Not a lot of people. Rates, there's such great data around rates, which I love. You guys do an amazing job.
Right.
And not a lot of people have visibility into the cost side, which, sometimes can remain stable, but we've lived in an inflationary world for the last few years. So the game's changed for sure.
Yeah, we've been keeping the costs coming in one end of the spectrum. Our DAT1 app captures a lot of the costs that come in, and operators tend to have a reasonably good handle on their costs, and they put them in and they get a sense of what the margin looks like on loads. But margins have been pretty slim for a lot of these operators because at this bottom part of the cycle, brokers' margins are getting compressed because shippers are trying to buy as low as they can in the market. And of course, carriers are getting squeezed at the bottom part of the market. But you would be seeing it on the other side, which is in the inflationary aspect of the cost side of running a trucking business. So the carriers are getting really squeezed on both sides, lower rates and higher costs.
Yeah, for sure. At the end of the day, when you run a business, there's only a couple of things you can do when you're in a tight market, and it boils down to revenue. So I got to work harder and I got to manage my costs and reduce my costs, which has not been easy the last few years in trucking.
Yeah. All right. There's some good discussion. We'll bring Todd back a bit later and we'll talk about some of those aspects of running a trucking business and what we've been seeing in the last few months. Let's dive into some of the key things we're watching in the spot market. Henry Byers last week was talking to a good friend, Zach Strickland at Freightwaves F3 last week. Henry works at KCH. He's the director of pricing there, and he used the word frothy. Henry, great description, one of the best descriptions, I think, of what we've been seeing in the freight market. I think frothy is a really good description for what we're seeing in the dry van market. Demand is pretty soft. I think there is something going on in the freight market. There is some volatility out there, particularly in the reefer market. More on that a little bit later. ATA tonnage came out down slightly, almost 1%, according to Bob Costello. Tonnage is still up about 2.1%. However, compared to the peak 3 years ago, the market still remains soft, sitting about 3.9% off its high. Rig counts, flatbed carriers serving the Texas oil patch are seeing a slackening in demand. as drilling in the Permian Basin slows to multi-year lows, according to Baker Hughes. As of mid-October, the Permian Basin, which is about where half of our rig counts reside, stands at 251. It's down from 304 a year ago. That's the lowest level of rigs since about 2021, since the new administration took office. Rig counts have declined by about 41, or about 7% since the Trump administration's drill baby drill election promise. Houston to Lubbock loads moved on flatbed carriers. That's the number one lane for flatbedders, down 40% year over year. So not a good year for flatbed carriers in Texas, as we all would have thought would have been the reverse case. But there's been some winners for those flatbed carriers that have been moving a lot of AI-related, data center construction-related building materials. So there have been some winners and losers in the flatbed market. Diesel prices, we'll get into that a bit later with Todd, but the recent drop in diesel prices throughout much of 2025, primarily driven by a global supply surplus in the crude market, fairly tepid global demand. Prices have dropped about 13 cents in the last month, or about 2%, and 4% in the last year. That's provided a much needed boost for small carriers in the spot market. Rates last week sitting at about $3.62, which is good news for carriers that don't have the opportunity to get the fuel surcharge built into their rates. Today's market update will be out this evening at dat.com/market update. All right, let's dive into the market condition index. As you'll see on the chart today, a little bit of a different index look. Instead of the outbound index, I'm showing you the inbound index, which gives you a sense of where capacity is tight into a market. These are the states, so this is what states have looked like in the last 8 days. So in practical terms, the colors tell you that this is where there is higher demand for inbound freight relative to truck capacity. No surprise, in the last 8 days, capacity has been tighter into Florida, Texas, and California, where ICE enforcement has been particularly active. Diving into some of those states, Lakeland, Florida saw a 12% increase in load posts. Remember, load posts are a proxy for how hard it is for brokers to find trucks. There was a 23% increase in load posts in Lakeland last week. This coincides with increased immigration and customs enforcement operation. Of course, all of the Florida scale houses and agricultural centers have been turned into enforcement centers across the entire state. Meanwhile, in Oklahoma, where ICE has recently been targeting foreign-born nationals operating commercial vehicles on I-40, Oklahoma State continues to experience tighter capacity. Load posts surged at 42% last week. Outbound rates up 3 cents to $1.64. Remember, these are line haul rates excluding fuel. Nationally last week, load posts up slightly, about 2%. Load to truck ratio ended the week at 6.23. The other notable area of tightness in capacity was the Pacific Northwest. A lot of challenges there for freight brokers up there. Of course, we're heading into fall produce season generally, so trucks are in tight demand as we head into Christmas tree shipping season. Also, load post volumes in the PNW up 17% last week, 60% increase in the Pendleton market. In the refrigeration market, also the inbound MCI, you can see here, similar pattern, a lot of tight capacity for trucks heading into Florida, Texas, and California. Also along the southern border, you can see there's tight capacity there. Of course, ongoing enforcement in Florida is impacting brokers' ability to find capacity. Load posts in Florida are up 33% in the last month, which corresponds, of course, with the increased enforcement activity, with the conversion of those scale houses into immigration enforcement activity. Load posts up in Florida 13% in the last month. Refrigeration load posts have had the greatest movement in Florida. Load posts in Florida in Lakeland, which is the biggest reefer market in the state, up 28% last week. This represents about a 35% increase in Florida since this new enforcement activity started at these checkpoints by ICE, where they started doing all the English language proficiency checks and immigration checks. Despite being months away from produce season, which of course really gets going in January, reefer rates in Lakeland are up 10 cents a mile already. That's about 3 cents a mile higher than where they were this time last year. In McAllen, in southern Texas, that's within the Rio Grande Valley, ICE activity has been extremely active down there. Reefer loads or load posts surged by 37% last week, up 42% in the last month. So brokers are finding it really hard to find reefer trucks on the southern border, particularly for loads to Brooklyn, Elizabeth, New Jersey, Miami, and Los Angeles. Outbound McAllen reefer rates up 7 cents a mile last week at $2.03. That's 7% higher than last year. The lane that is getting the most attention is Los Angeles. It's about 1,600 miles from McAllen. Carriers were getting paid $2,910 per load. That's about $800 more per load than this time last year. And if you've been following our market updates, you'll realize that a lot of the capacity that services McAllen for loads back to Los Angeles, of course, comes from California itself, which has been subject to a lot of immigration activity, and accidents recently have been top of mind in the press. The flatbed inbound MCI also shows a lot of the same sorts of stories: southern border, Florida, Texas, California, very similar to reefer and dry van. Load truck ratio last week up to 23.81. There's about a 3% decrease in load posts, though, slight reduction in equipment posts. So relatively flat market last week in flatbed. Freight brokers had some capacity restrictions in the Miami market again last week. Load posts are up about 42%. Also some capacity tightness in the Pacific Northwest. Load post volumes are up 18% last week. Some tightness also in the Portland market. I think this might have a little bit to do with Christmas trees starting to ship a little bit earlier up there. Regional spot rates in the PNW up 12 cents a mile last week. The average outbound rate out of the Pacific Northwest was $2.41 excluding fuel. Portland, which is the largest flatbed market up there, saw a 24% increase in load posts, mostly for loads going to San Francisco and Stockland. All right, year over year look at spot rates. Let's wrap this up quickly. Spot rates up 2 cents a mile last week in dry van, averaging $1.72. That's sitting about 4 cents a mile higher than last year. On our top 50 lanes, they averaged $2 a mile last week. And in our 13 key Midwest state, just under half of our volume of loads moved come from 13 key Midwest states, or our bellwether states as we call them. They were up 2 cents a mile to $1.95. Having a look at our refrigerated market, the 7-day rolling average excluding fuel climbed 2 cents a mile to $2.10. That's sitting about 12 cents a mile or 6% higher than last year. It's slightly higher than 2018, which that market, of course, was cooling by the time we got into October, but we're about 5 cents a mile higher than 2018. And lastly, in flatbed, rates were flat last week for the second week, ending the week at $2.07, sitting about 6% or 11 cents a mile higher than last year, and for the second week higher than 2017 by about 3 cents. All right, quick look at our 35-day forecast. Now we're getting into the back end of the Halloween period here. We're seeing Halloween start to emerge into the 35-day forecast. These are the ratecast forward-looking forecast. Yellow is the upper bound, the red is the lower bound, green is, of course, the 35-day, and the blue is the historical 7-day average. These are loads moved over 550 miles, excluding fuel. So this takes us right up to Thanksgiving, ending on Black Friday. For the first time this year, we're getting a look at what we think seasonality could look like. In dry van, ratecasts expect rates up 5 out to November 28 or 29, I think it is, at about $1.77. This time a year ago, they were $1.67. So if ratecast is on the money, rates will be 10 cents per mile higher than where they were last year. In the refrigerated market, reefer is expecting rates to be up 11. You can see there on the chart that it expects rates to peak just before Thanksgiving. Again, that's fairly normal. This year, it's expecting rates to peak at 221. Compared to last year, rates were 205 at that time last year. If that happens, rates will be about 8% higher than where they were last year, or about 16 cents per mile higher. There's every chance ratecast will be spot on. I'm thinking that maybe even the higher case scenario, the yellow line, could even be closer to where things are going, the way that refrigeration market is tightening, especially on some regional lanes, seeing some real tightness there. So reefer is looking like being fairly aggressive this year in terms of what the market forecast is looking like. Certainly up 11, I think, is being fairly conservative. Flatbed down 1 cent out to November 28 at 205. Even if that happens, compared to last year's 193 at Thanksgiving, rates will still be up 12 cents a mile. So that's underpinning the very good year flatbed carriers are having. All right, let's bring Todd back in. Todd, first question. How are owner-operators and small fleets continuing to survive in this almost 3.5-year downturn?
You know, Dean, it seems like that's the most common question that's been asked over the last couple of years, because a typical downturn, you kind of weed out that capacity and things get better a lot quicker than it has. And as I've been kind of reflecting on that over the last couple of years, and it's really come into kind of clarity for me this last round of visits. And part of what we do at ATBS, we have a lot of independent clients that have their own authority and run their own business, but we also get a lot of customers through large truck lines, all the names that you would know. And so visiting and just hearing what's going on, I almost got to go back to deregulation in 1980 and think about the fundamental change that's happened in our industry. And you think back to then when trucking just became fragmented because of deregulation. Anybody could get authority and drive a truck. And over the ensuing 10 or 15 years, what happened is that shippers lowered their costs. Of course, deregulation tremendously lowered the cost of transportation, but it also frustrated transportation managers because they got thousands of carriers in their network. And it just, before technology, it was not possible to do bid packages, maybe every 2 or 3 years and manage safety ratings and all those things. So a lot of carriers started moving to what was called a core carrier concept back in the, mid 90s into the 2000s. And they tried to consolidate from thousands of carriers down to 500, especially big shippers.
Right.
And they continued to do that. And then, we hit COVID, and all of a sudden there's not enough trucks even close to all the freight that is out there. And I heard this from one of our partner carriers that was a big John Deere hauler, and they said that the CEO of John Deere said, "We will not miss the delivery of a piece of equipment to one of our customers because we can't find a truck. I don't care what it costs, go find the truck."
Right.
And so our industry, as truckers, we essentially forced on shippers during COVID a way. They had to change the way they did business. Brokers used to be kind of a little bit of a dirty word, right? Shippers did not want to use them. They helped now and then with some excess capacity, but it was viewed as capacity that was not optimal. I
Right.
think we forced the brokerage network with the evolution of technology
Mhm.
and all the things we have. We forced that into becoming more of a core carrier than it had been before. These shippers realized we can use brokers, we can find quality small carriers to haul our freight.
Mhm.
And COVID proved that to them. At the same time, transportation costs went up more than they ever had before, and the transportation budget at a large corporation all of a sudden got the view of the CFO and the CEO, not just the transportation manager, because of the inflationary costs. And
Mm.
so when the market turned, unfortunately, in 2022, shippers realized something new. They
Mm.
can drive costs extremely low by using fragmented transportation and kind of move away from that core carrier concept. So
Mm.
there's a lot more that plays into it. I
Mm.
think the cost disparity that used to happen between large carriers who had incredible buying power on everything from trucks, fuel, tires, maintenance, to the small carrier who now can use a DAT one and get good fuel discounts.
Mm.
They used to get 5 or 10 cents a gallon if they paid cash. Today they can get 40 or 50 cents a gallon if
Right.
they're using a good fuel network. So I think the cost disparity got compressed between large and small. And I think shippers realize they can use, small carriers
Mm.
through the brokerage network and even sometimes directly. So I think all those things
Mm.
really without anybody intention, and technology, of course, is
Mm.
what has enabled all of this
Right.
through DAT load board, right? So I think the game fundamentally changed in COVID more than we actually realize. And
Mm.
it's allowed those small carriers, while they're not setting the world on fire and making
Mm.
record breaking profits, they're able to sustain their business through a time that they haven't been
Mm.
able to before. Some have gone out of business for sure,
Mm.
but a lot of them have made it through this time, right? And
Mm.
you can always go to the banks that are doing interest only loans because they don't want the truck back because they lose money on it. And there's all those kind of traditional reasons that capacity stayed in. But I think the game's changed
Mm.
from what it was before.
It's interesting you say that, because I think there's a lot to that. We were at a shipper conference with our shippers recently, and they're talking about API pricing, and they only were dealing with carriers that had the ability to have API technology where they could send out loads via an API connection. They call them API carriers, which is a really interesting concept. So it wasn't really using load board specifically, and they weren't core carriers that they would send out loads via EDI. So they weren't contract carriers, but they were carriers that they would hit via API, and they were measuring their performance by fractions of a second response times to
Mm.
the bid. And it was like, really, that's how you measure it wasn't by service, but it was response time. And of course, that tells you about the carrier. So the carrier has to have the ability to have a a tech stack and staff to build that technology on their end. I mean, you're not talking about massive carriers here. You're talking about smaller carriers that want to get into that space and break into large shippers. But it enabled smaller carriers to break into that market that was typically the domain of the larger carriers. So that was another thing we saw that was allowing smaller carriers to get into that market, where shippers were playing that market. And I think what it did, though, was it was flattening out the market. You were reducing the level of rate volatility in the market, because what we were seeing was that everybody in the transaction, brokers, carriers, and shippers, were all seeing the same data almost at the same time, and that was reducing the volatility. So you were sort of seeing less volatility at a lane level, and it was just making these market cycles seem flatter. That's what it seems like over the last few years. And maybe that's the new norm, is that we just don't see the sort of market volatility that we saw maybe before the pandemic. I mean, time will tell, but that's what it feels like heading into this next cycle.
Yeah, I agree with you. I think technology for sure has changed and enabled, right? And how many brokerages do you know that went from 0 to $100 million during COVID? And some of those have gone out of business, but some are still around. And yeah, a lot of these 100 truck carriers have pretty sophisticated technology these days.
Yeah. Well, even a small, owner operator, or someone's got a few trucks, they can avail themselves to all sorts of technology on an app these days. As shows like this, you've got shows. You like look at your blog posts or the education that comes out of your website or your business now. I mean, the pandemic really forced us to engage a lot with our customers. You've done the same thing, but just look across the entire network of information that's flowing out to consumers. You'd have to have your head in the sand not to understand what's going on in the trucking market. Like I don't think you'd have any excuse not to know what's going on in the market. Now, I'm sure there are people that don't understand what's going on, but I think if you look at pre and post COVID, there has been a massive increase in the amount of information flowing out into the industry. That I think is also what it's done is it's sped up the adoption of response. Like the response times to change has shortened dramatically. I think what that's done is it's flattened out all of those peaks and troughs.
Yeah, and it's taken away because of information, the old excuse that I'm not going to run north of I-40 in the winter because it snows, and I'm not going to go to the Northeast. And
Right.
I realize if I'm going to stay in business because of the information you put out on rates, sometimes I have to make different decisions than I learned from my dad and my uncle. I've got to pay attention and understand the market.
Right. It's really interesting. One of the things that I didn't touch on there, and I kind of alluded to it, but I've been writing about it in the last few weeks, is the flatbed market is so robust at the moment, and it looks like 2017, which of course was a very strong industrial economy, and the rates coincidentally look like 2017, but for different reasons. And it's got to do with the AI boom and the massive growth in data centers. Right? But when you break down the flatbed market, the contract flatbed market is actually down about 2%. Rates are down about 2% year over year, but flatbed spot rates are up 3% year over year. So why the spread between the two? Well, it's because data centers are in the middle of nowhere, where you've got cranes, maybe permits, and a massive deadhead. And because it was a data center that popped up, it probably wasn't in last year's contract bid with a shipper. So it's a spot market move first and foremost. And that's what really has boosted the flatbed spot market. And when you look at investment in data centers, it's up 200% since ChatGPT was launched. So if you think about flatbedders hauling data centers, a lot of them are moving on RGNs and drop decks that are a little bit overdimensional at times. They've been doing exceptionally well in that market, whereas the guys that are sort of the backbone of that oil industry haven't been doing so well because they're not drilling as many holes in the ground. So there's been winners and losers in the market. It hasn't been enough to lift the entire market, but for those that have been willing to run different lanes in different areas to different markets where they maybe don't know what the freight's like coming out of those markets, it's actually been really good for them. So I think that's sort of going to be the story going forward, because I don't see any let off in the construction of things related to data centers, in particular nuclear power, as it relates to where these data centers are being built.
Yeah, I think that's so insightful, Dean, and it goes back to understanding the data because our flatbed net income is up significantly, 10 to 12% versus everybody else for the last 12 months. And um, it's definitely not farm equipment, right? They
Right.
killed
Yeah.
it during COVID on farm equipment.
Right.
You made so much money moving farm equipment, but that's, very it's terrible business right now.
Right.
So you have to understand. And the oil boom, we would have all expected because the drill baby drill is not
Mm,
happening yet. I don't know
mm,
if it will.
mm.
Um, I don't know. There's infrastructure spending, right? I don't know how much of that $1 trillion+ that got passed a few years ago by the government is actually making it out. But when I travel, I see a lot of construction happening in roads and things.
Mm,
So yeah, you're right, Dean. You got to understand
mm.
where it's not just that flatbed is good, get in flatbed. It's where is flatbed good? I need to
Yeah.
be there.
Yeah. Well, we see about 30 to 35% of our moves in flatbed are moving on the spot market versus about 15 to 16% in dry van. So it's a disproportionately high amount of freight is moving on flatbed. And that's why I think they've done so well in that market. Now, of course, heading into winter, that's a tough gig, right? Flatbedding is tough, but I think they've done very well. It's interesting talking to some guys at a truck show yesterday. They're, swapping out their vans and getting into flatbedding. So there's sort of this interest in getting into flatbedding from guys that have been around for a while. And I think they know why. They know the getting's pretty good out there. All right, so let's enough of that. Let's get into some of these other questions. What are income and expense trends that you're seeing with small fleets this year? What's some of the things you're seeing?
I'll just give you some high level ones. We talked about it at the beginning. When I'm not making enough money, what do? I got to save on my costs and I got to work harder. So we have seen for now 2.5 years, drivers running more miles. Our average clients running about 95,000 miles. Before COVID, they were running about 108,000 miles. And then at the height of COVID, they were down to 85,000. So we had a huge drop in mileage because drivers were making so much money, they didn't have to work that hard. So we continue to see that mileage rise. They're working harder. From a cost perspective, you talked about it, fuel. It's been down, which is really
Mm,
nice. I mean,
mm,
at the end of the day, fuel is kind of a variable cost that gets factored out of our industry because we can't afford to take the risk on wild swings in fuel. So even though it's not necessarily a specific component of the spot market, the fuel surcharge is a huge piece of our industry. So, we show year over year, fuel costs are down 7 cents a mile and rates are down 7 cents a mile to equal that, which means an equilibrium market. But like you just mentioned, fuel being down in the last 30 days, 13 cents, that's a couple cent a mile gain. The fuel surcharge, the rates will adjust to that over time, but
right.
that's an instant pump savings cash flow wise for drivers. The things that have hurt drivers, of course, truck payments over the last 3 or 4 years.
Right.
Our average driver used to pay $2,300 a month for a truck. Today they're paying $2,900. That's a long-term fixed asset. That's not something that changes when things change next month. So that's an inflationary cost that's built in. Um, Fuel overall for our drivers is okay because drivers have learned when I save $1 in fuel, it goes to my bottom line. So better buying networks, better miles per gallon. We've gone from an average of 6.5 to 7.1 for miles per gallon. Maybe the thing that hurt the most in the last year has been maintenance. We see maintenance up to 18 cents a mile for our average independent driver. And that's a lot. It's
Mm,
$100 a month in increased cost. And when you think about it, the dealerships and the OEMs are not selling the trucks that they need to sell to make enough money. And so what do? They make money on parts and labor. So those have gone up pretty significantly.
that's a lot.
At the end of the day, I can say that net income is up a bit, 2.5% for our average clients. So, we've seen the bottom. It's not rising enough or fast enough, but at least it's not going down.
Right. So, Todd, so as we come up sort of the top part of the show, how quickly do you expect capacity to come back when the market rebounds?
Dan, I'm hopeful that capacity is not going to come back really quickly for a few reasons. We have a lot of tired, old, used trucks in the market because we haven't replaced a lot of trucks. So we're not going to have a ton of really nice 500,000 mile used trucks. We're going to have 700 or 800,000 miles when the market turns and people start buying new trucks and trade them in. At the same time, we have not created a bunch of new owner operators like we have in the past. A lot of the lease purchase programs, which was spawning ground for owner operators, they've been reduced and shut down over the last 3 years. So, and there's a lot of good paying jobs in America. I can make $60,000 doing a lot of things. Why am I going to drive a truck? So I don't think it's going to be as easy to add a bunch of trucks and drivers when things turn around as it has been in the past. So hopefully it's as drawn out of an upcycle as it has been a down cycle.
That's a really good point. That's a good point about the other jobs that people have got. Plus, I think, Todd, this will be interesting. I'll get your take on this. I think the FMCSA will make it harder, hopefully through everything that's going on, harder to get a DOT and MC number through all of the work that's right. So it should be harder next year.
It's always been hard. It just hasn't been enforced, right? So you can make all the laws you want, but unless you enforce them, it doesn't matter. And yeah, we all have this huge question mark about what enforcing English speaking language is going to do to capacity.
Right.
It should never happen in the first place, but
Sure.
the fact that it has, it's going to be interesting to see what that does. Yeah, we need safe trucks on the road, and hopefully our government recognizes that and enforces that.
Yeah, I think there's a sense that there's the reckoning is happening on the road. I see it, and it can't happen soon enough with some of the crazy stuff that's been going on. I mean, I've been seeing it for 4 or 5 years, and like it's hard to put your finger on it. But when you see what's going on, like with some of the video footage, it's absolutely frightening with what's going on. We see it in the rates. Like you and I've talked about, how is it that the industry's been able to sustain such low rates for so long? Like, and all of these things are part of it. Like, how do people sustain such low operating costs? Because none of it makes sense economically.
You can only break even for so long, right? You can't do it forever.
One of the great things that I think you've said to people, and I'll get your take on it, this still holds, is +1 -10. Is that still the advice you give to your guys?
Yeah, and really what that meant was take an extra load a month and reduce your speed by 10 miles an hour. Or, it was important because we had to change the mindset post-COVID, because speed didn't matter, fuel didn't matter. I just needed to get the next load as fast as I could. You have to save money on fuel these days. It's just in a market like this. And people stop driving as much. So I'd say by and large, the trucking population has adopted that and they've changed course. So the world will change again, right? When rates go up, it might be more important for me to drive a little bit faster, not exceeding the speed limit, but to get to that next load that pays really well. So those are still important to pay attention to in this market.
Having said that, I saw a video of a bull hauler the other day. You'll get a kick out of this. He had 299 rears, 277 rears, and he was at 1,500 doing 95 miles an hour.
Oh my God.
He was in Colorado and he posted a video of it.
Oh my God. I mean, yeah, well, I've driven around my share of bull haulers, and I've driven a lot of remote roads in Colorado. So maybe there's places you can get away with that. But
why would you post a video of that? Like,
how many likes and how many views did he get? That's why he did it, right? He probably had 100,000 people go, "That's awesome! Oh, cool!" But hopefully the police are on to him.
Posting a video of it was insane. I was impressed with the 1,500 RPM. Like, I'm thinking, wow, that's pretty impressive. That's some good gearing.
Gosh.
When I watched it, I was thinking of your +1 -10. I'm thinking it's a guy that needs Todd's advice.
I hope he's not on the roads I drive.
Yeah, the bull haulers. They're another league. All right, so a couple of shout outs. Todd, how can people get in contact with you if they need some of your advice?
Sure, Dean. 2 ways that are real easy is just atbs.com. Our phone number is 888-640-4829.
All right, good. I'm on with Radio Nemo almost every day, but I'm on with them every other Thursday, Road Gang Radio on iHeartRadio, YouTube, or Facebook Live, 7 a.m. Central. Chris Kaplis has got a new show out this week on the Freight Vine podcast with John Motley from Logneck, talking about how importers and retailers are leveraging AI and mitigating the volatility of tariffs. Next week's show, Robert Rouse, very own Robert Rouse from DAT, is on. That wraps up this week's show. Make sure you subscribe to our channel, set up alerts so you know when the show is about to start. With that, another show's in the books. Thanks for watching. Be safe, be nice to everyone. We'll see you back here again at 10 a.m. Eastern, 7 a.m. Pacific.